Welcome back, everyone. We are in for a huge week. As we know, we have two of the big ones reporting earnings this week. Amazon and Apple, the two giants. Amazon's reporting this Tuesday, Apple's reporting this Thursday. But we also have a list of other very important companies. Like I said, it's going to be a big one. This is a huge week in the market. Just today, we had two companies that I think are rather important that reported earnings this morning. Sofi, the tech bank company, the financial service kind of fintech bank company, they reported earnings. They're down big today. We'll explain why. We have Dominos. Dominos reported earnings and they're up today. Again, I'm going to go over that one as well. And then we just have a whole list of companies. Now, I highlighted the ones, like I always do, that we're going to be going over in this video. And I'm going to be giving you analysis and thoughts and predictions on each one of these companies. But you can see them circled here in red. We have a huge list of companies to go over. For example, when we move into Tuesday, we have PayPal and McDonald's reporting earnings before market open. That's going to be a busy morning. But then Tuesday, after market close, I think is going to be the biggest day of the week, maybe next to Thursday. But Amazon's report, I believe, is critical. It's a critical report for Amazon. I'll be going over why I think it's critical, why I have so much money invested in Amazon, and what I think is going to happen. And then, of course, we have Starbucks reporting at the same time. Then we get into Wednesday. Halfway through the week, we have Mastercard, another one of my large holdings that's reporting earnings Wednesday before market open. And then Wednesday after market closed, this is one that I personally added in. So this wasn't on the sheet here. I slipped it in because it's a company that I think a lot of people track, which is VICI, one of our favorite real estate companies. This one has been struggling this year. I'm going to be talking about it in this video. Now, moving further down the week, we get to the next big juggernaut, which of course is Apple. Apple's reporting earnings Thursday after market close. So that's going to be highly anticipated earnings because Apple, I believe, is the most followed stock in the market. Even more followed than Amazon. In fact, when I look over my analytics on Qualtrim and I look at like the top 50, top 100 most searched stocks, Apple is consistently number one. Beats out everything. Beats out Amazon, Tesla, you name it. Apple's always number one. And the reason why is because this stock is good at everything. It's a growth company, it's a value company, it's a dividend grower, it's a buyback machine. It's a company that has its hands in everything. But right now, I believe Apple's facing a list of challenges. They're facing challenges with China. They have their headset that's questionable. They have a lot of things that I think are challenges that I'm going to be going over when we get to Apple. So that's another one we're going to be covering. I'll be spending some time on that one. And then, of course, during market close on Thursday, we also have Texas Roadhouse. This is another one that I had to add in because it's too small of a company to be listed as one of the top stocks here. But it's a big one within my community because I have a significant investment in Texas Roadhouse. This has been one of my biggest winners, and it's up big. So we're going to be looking at Texas Roadhouse and my expectations. And then finally on Friday morning, I also threw in Hershey's. I have some opinions on what's going on with Hershey's. So this is a huge week. We have a lot to get into. If you like this type of analysis and commentary, make sure to like the video. That way it gets spread amongst other people. And if you haven't already, consider subscribing to the channel. I think you'll like other content if you like these videos. So let's go ahead and start off. We'll start off on the beginning of the week, which is Monday, before market opens. So these companies have already reported earnings. We have Sofi and Dominos, both companies having reported earnings already. Let's go ahead and take a look. Right here, Qualtrim says that Sofi shares are trading lower, reversing after earlier gains on Q1 earnings. So it looks like it went up and then they had something come out later in the report that made the stock go down. Now, the reason stocks go up right after earnings is because they beat their earnings per share and their revenue estimates. So like right when the stock posts its earnings, right when the print drops, the stock may go up because investors are excited they beat their earnings and their revenue expectations. But then if it drops later on, reversing earlier gains, that's almost always because of additional information found out through their guidance. It's usually through their guidance. So on the earnings call, when investors and analysts are asking the executives, hey, what can we expect for next quarter? And the executive team says, oh, we're going to see a little bit of weakness here, or a little slowdown there. That makes the stock drop down. And that's exactly what happened with Sofi. Sofi beat on their revenue and their earnings per share, but that was last quarter. The guidance they gave was a little bit weaker than expected, so the stock is down 10%. Now, more broadly on SoFi, this is a company that I have to talk about because I see a lot of enthusiasm here that I find a little bit perplexing. I find that I'm a little bit baffled of how interested investors are in SoFi. For whatever reason, there's a lot of retail investors that love this company. They want to own more of this company, and they talk glowingly about this company, like it's going to revolutionize the world. Now, I get that SoFi is a cool bank. It's a fintech company. It has some financial service applications. They issue loans and credit cards and do other things that banks do. They do it with a nice user interface, and they have some additional software aspects to it. But ultimately, SoFi is a financial service company. It's a bank. Lots of banks have technology along with them. JP Morgan has technology along with it. SoFi is a financial service company, but investors in many cases talk about it like it's going to be the next Microsoft. And this is what I find perplexing and what I want to give a warning about. I see tweets like this. Now, I don't respond to all of these because I don't like causing drama, but I think it's worth it to push back against tweets like this because a lot of people see these. We have a Twitter account here named StockGoat. Now on Twitter, you can just make up whatever names you want. So you can call yourself the stock king, the guru, the finance guy, the real estate guy, whatever you want to call yourself, you can. It doesn't mean anything. But we have this StockGoat here on Twitter. He tweeted out, buying SoFi today is like buying Amazon in 2003. Now, this isn't like sarcasm. This isn't a joke. There's no irony here. He's very much comparing buying SoFi today like buying Amazon in 2003. And then he does so because of 4 years of net income. As if comparing 4 years of net income from these two different companies is just conclusive evidence. That's the case. Look at it. Net income in 2000 to 2023 went from negative to positive for SoFi. And net income from 1999 to 2002 went from negative to positive for Amazon. Aha, you see the comparison there? In both companies, the net income went from the negative to the positive. And that means SoFi is just like Amazon because there's not a million other companies where the net income goes from negative to positive. The only two are SoFi and Amazon. Now, aside from this ridiculous comparison, you think that most people would just ignore this, it'd be left in some corner of the internet, but this was viewed 90,000 times. 90,000 is a lot of views. It was retweeted 32 times, 56 comments, 335 likes on this, 76 bookmarks. People bookmarked this so that they can reference it later, so they can save this. Now, I don't know if you need to hear this, but I'll say it anyway. Buying SoFi today is not like buying Amazon in 2003. SoFi is not going to go on to create AWS and own the biggest market share of cloud hosting, which is one of the biggest businesses in the world. They're not going to go on to create a fulfillment center that has revolutionized the entire US and taken over FedEx and USPS in size and scale. They're not going to go on to control 40% of online sales in the US. They're not going to go on to control an advertising market that is only surpassed by Meta and Google. SoFi is not going to go on to create a streaming business that has 300 million subscribers. These type of comparisons that you see online, although they may seem ridiculous, we see them over and over again. And it's like a lot of people are saying this is a joke, but I'm out of the joke. I see a lot of people that are agreeing with this, nodding their heads, saying, yeah, it's just like the next Amazon. It's like buying the next Amazon. SoFi will just grow to become a multi-trillion-dollar market cap company that controls multiple sectors of the US. Now, SoFi may not become the next Amazon, but that doesn't mean it's not a good company. It can be a company in its own right. The issue I have here is the constant comparisons to Amazon. If you're comparing your company to Amazon as part of the thesis for investing in it, you've already lost. That's a losing thesis. Amazon is a 1 in a million extreme outlier event that will not likely happen again in our lifetime. So everyone that's comparing stocks like Sofi, fintech companies to Amazon, you're playing a losing game. Invest in SoFi, invest in these companies based on their own theses, not based on buying the next Amazon. Now, next up, we have Dominos. They also reported, and we have a lot of food companies this week. We have Dominos, McDonald's, we have Starbucks, and we have Texas Roadhouse. So let me go over Domino's report, and then I'll speak more broadly. When we look at Domino's here, it's up 5% after hours. We have Qualtrim noting that Domino's Pizza shares are trading higher after the company reported better than expected Q1 earnings, with same-store sales growing 5.6% in the US and 0.9% internationally. What I noticed from this is that the numbers in the US are doing better than the numbers internationally. Domino's did 5.6% same-store sales growth in the US and only 1% internationally, meaning that US customers are both spending money and they're hungry. They're spending money on fast casual dining, on fast food, on pizza, on different food items. And this is something I've been saying for a long time. I've been saying that food companies are good bets. I've been saying this for 3 years straight. People are on the go. They don't want to make food at home. In many cases, they want it prepared right in front of them very quickly and efficiently. The companies that offer these products at scale, at good cost, with good economics and good balance sheets, I think would do really well. So in my portfolio, I've had a strong emphasis on food companies, and these ones have really lifted my portfolio. Now, I don't own Domino's. This is one that I've looked at previously, and I owned it for a short time. But this one is also doing really well this year. It's up 26%. Domino's got way too expensive. It got overvalued way back in 2021. It traded down like many stocks, and we see the big recovery as they're restoring their same-store sales growth. So I like what I see from this report. I think it's very strong. They're growing same-store sales 5.6% in the US, which is good. But I think the companies I own are a little bit better. Chipotle and Texas Roadhouse, I both think will be stronger. Now, moving on from Monday, we get into Tuesday before market open. There's two companies I'm going to go over, PayPal and McDonald's. Let's go ahead and start off with PayPal. If we look at it here, going into earnings, I think investors are wanting to see any type of momentum. Momentum in users, momentum in free cash flow per share, momentum in revenue. And I know you say, well, of course they do. They want to see that for every company. But in specific, they want to see that for PayPal. Because this stock has been relatively the same for like the past 5 years. It just hasn't gone anywhere. And since 2018, the free cash flow has been relatively the same. So what we see here is a stock that is not generating a lot of alpha. If we look at free cash flow per share, there's been no free cash flow per share growth for over 5 years. In my opinion, that is unacceptable. I do not want companies that have no free cash flow per share growth for 5 years. So the only case I would own a company like this is if I see a strong turnaround in the stock. A lot of people have bought it just on valuation alone, but that's not enough reason for me to buy a stock because the valuation has improved for PayPal. It's come down now, and the stock price is doing okay this year. It's up 9%, but over the past year, it's still down 10%. And that is because if we look at what's happened at PayPal over the past couple of years, we've had Apple Pay enter the market and Google Pay and Amazon Pay and JP Morgan's payment systems. And we have all these competitors entering in. We have, what is the other one? We have Shopify Pay. We have all these different companies entering into this market, putting more concern and pressure on PayPal. Meanwhile, their fundamentals aren't improving like investors expect. So with PayPal going into earnings, I don't have a strong opinion on this one. I think it's just going to be mostly inline earnings, nothing unusual. And I think they'll post about what investors are expecting with free cash flow. I do not predict any huge beats with it or any huge disappointments. Maybe we'll see that, but I don't have any reason to believe they will. Now, after PayPal, we have McDonald's, and I like this stock going into earnings. There's no guarantee it'll go up after earnings, so I'm not predicting that, but I just like the situation here of it going into earnings. It trades at a lower valuation. McDonald's is no longer at the extreme end of the valuation scale. It's at a 3.5% free cash flow yield, 21 forward PE. This is a decent valuation for a very strong company. We look at the stock, it's sold off this year. It's down 7% year to date. And you can see how it's dropped down over previous earnings reports. It's dropped down because McDonald's took too much pricing. They raised prices too much. They saw a fall off in different customers, especially lower income customers. That hurt their sales. So they've eased up on the pricing. They've actually lowered prices in some categories, offered more incentives, and I think they're going to see better customer reception due to that. So with McDonald's, I see this company really well positioned. Strong fundamentals. I'm very bullish on food franchises overall. I think they're smarter about their pricing strategy now, and the stock has fallen off with the valuation being a little bit better. So overall, I don't own it, but I feel good about McDonald's going into earnings. Now, moving on to Tuesday after market close, we get to the first huge earnings report of the week, which is Amazon. I first want to mention that I own Amazon in the secondary portfolio. So if you haven't seen the story fund, this is my secondary public portfolio that I track every single week publicly. I show all my positions and the returns of them, and Amazon's my largest position, making up 35% of this portfolio. So if you take the index weighting, the index like the S&P 500 or the QQQ, I'm weighting it around 3 to 5 times as much as the index does, because I feel like the extra exposure to Amazon will yield me better returns than the index. So this is a major bet of how I plan on outperforming the S&P 500 and the QQQ. It's by overweighting Amazon, which I believe is going to have very consistently good returns over the next 5 years. And that's off the basis of these upcoming earnings reports this year in 2024. There's a lot going into Amazon's earnings report this quarter. Amazon is expected to have continually high free cash flow per share. And that's something that we haven't seen in years past. So if we look at Amazon and we just look at their free cash flow per share or their free cash flow per quarter, we see that last quarter, it looks like a bit of an outlier. Doesn't that look like it's almost a data error? Like it's just a bar that's too high compared to the previous ones? That's not a data error, that's correct. Amazon produced $27.8 billion in free cash flow in Q4 of 2023. Now, my prediction is the free cash flow this quarter will be somewhere between 5 to 15 billion. So we'll have around, let's say, $10 billion in free cash flow this first quarter of 2024. If we look at that on a quarterly basis year over year, if we go back 1, 2, 3, 4 quarters ago, the free cash flow is minus 9.42 billion. So we're going to go from minus 9.42 to potentially positive 10 billion. If we do that, that is a $20 billion swing year over year in free cash flow. $20 billion from minus 10 billion to positive 10. And I think Amazon could pull that off if they want to. Now, I said before that I think this year Amazon will produce around $70 billion in free cash flow. And I believe this first quarter is their first step on that path. They only have 4 quarters in the year. So this is a big one for the company. How do they produce this explosive free cash flow? A combination of all their major segments of business growing quickly and their expenses going down rapidly. The expenses going down along with revenue growing creates that operating leverage and that huge free cash flow margin in between. And we can see this illustrated in the revenue by segment. On Qualtrim, we have a breakdown of all the different main revenue lines for Amazon. For example, we have the first-party online sales. Now, first-party online sales is the stuff that Amazon sells in their own store. Amazon started as only first-party. They didn't have any third-party sellers on their store. It was just Amazon products that they listed and they sold. But first-party has become a lower margin portion of the business that they typically use to create a robust online shopping experience. In most cases, first party is what they use to fill in the blanks. So Amazon will create first party items of things that other third party sellers don't really want to sell because they're super low margin. So this portion of the business is not super important. It's not critical to Amazon's profitability. It's more just to complete the customer shopping experience. And you can see that it's not growing that quickly. If we go back to 2018, it was doing around $28 billion per quarter. Now it's doing around 70. So it is actually growing quickly, but it's just not growing as quick as other parts of Amazon's business. This is a massive portion of their revenue, but very low margin, and in my opinion, not the most important. When we move on, we get to physical stores. This is really kind of a sideline. I don't pay attention to the physical stores too much. This is part of Amazon's ecosystem. They own Whole Foods and they own some other brands. They're doing some experimentation to see if they can disrupt physical retail, but that has been very difficult. And as you can see illustrated here, there's almost no growth in physical stores. They're doing too much experimentation. This is kind of their long shot bet. And if you compare the numbers, like if we put these next to each other, it gives you an idea of how small the physical stores are compared to their first party sales. It's insignificant. Now we move on to third-party sales. This is where other third-party sellers can list their products on Amazon and they can use or not use various services that Amazon has created. So Amazon creates all these different services from packaging and picking and transportation and logistics. This is what Amazon has invested hundreds of billions of dollars into building out within the US. And then they sell these services to third-party sellers who can choose to use them or not. Now, Amazon charges fees based on everything you use. So if you use their logistics, transportation, their storage, they charge for all of that. And they have all these different pricing schemes for all of it. In total, if a third-party seller uses everything that Amazon has to offer, they used all of their services to sell their stuff, it can be up to 50% of their revenue gone in fees to Amazon. But again, that's on a scale. That's if they use everything. Some sellers use like 20% of the services, and then they pay Amazon 20% of the revenue, right? It depends on the amount of things they're using. But overall, sellers are finding that it's cheaper to use Amazon's services than it is to do everything yourself, because trying to rebuild their logistics is incredibly difficult. So more and more sellers are using these services. Amazon is flexing their pricing power with these services more, and there you can see the rapid revenue growth. These numbers are huge. Again, if we compare this against the physical stores, you can see the scale and magnitude of growth here. This is growing like crazy. It's growing much faster than first-party sales. When we put these next to each other, you see them starting off the same, but over time, it looks like the third-party sales are catching up. And it's certainly growing much faster, in fact, around triple the speed of the first-party sales. So this portion of the business is much higher margin than first-party sales, much higher margin than physical stores, and it's growing much faster. The next pillar of Amazon, which I believe is increasingly the most important part of Amazon, is the advertising business. We know from Meta and Google that advertising is incredibly important. Both of these companies make a fortune from it, and advertising on Amazon is a direct click in the funnel. People search products on Amazon with the intention of buying right there. They already have their credit card information. You already have checkout. You already have fulfillment. You already have everything in there. Amazon has, in front of advertisers, the best customer base in the world that's willing to click and buy something at a moment's notice. They'll click and buy something. And Amazon allows you to advertise right in front of that incredible traffic of customers. You can talk to third-party sellers. They'll say that the value in advertising on Amazon is you get access to customer base you do not get anywhere else. You don't get it on Shopify. If you spin up your own Shopify store, good luck. You're going to have to pay for advertising on Google and YouTube and try to get people to your store. Amazon, there's already people there. They've already searched for items. You're just getting your listing above other people's. So the advertising is incredibly powerful, and you can see the rapid growth. They only started disclosing this since 2020. So in Q4 of 2020, that's the furthest they've gone back, and they actually first disclosed it a year after that, but then they went back 4 quarters. In Q4 of 2020, advertising was a $4.9 billion business. That was just 2020, 4.98. So we can round that to 5. Right here, it's a $5 billion business, and now it's a $15 billion per quarter business. That means that the run rate right now for advertising on Amazon is $60 billion. This is a massive increase in run rate in just the past 4 quarters. It's ramping up quickly, and I have to believe that the margins on advertising are at least 40%. I think they're probably higher, closer to like 60%. The explosion in advertising revenue, which is a highest margin revenue, is very important to the thesis of Amazon. So I look at this with a huge potential. I think it's incredibly important to Amazon's success. And we have some metrics to go off here as well. When we look at Microsoft's most recent earnings report, LinkedIn revenue, which is a social media advertising company, was up 10%. So even LinkedIn, that's been around forever, they're pushing advertising that's in the double digits. Then we go to Meta. Meta had a monstrous quarter. Overall revenue for Meta was up 27%. Advertising specific revenue was up 26%. So we have around 26% advertising growth in Meta. And then we also have Google. Of course, the majority of this business is advertising. They grew 15% year over year. So I think given the comparables between Meta, Microsoft, and Google, and how fast their advertising specific businesses are growing, that Amazon's is going to be good. Now, I can't predict with exact precision what the advertising growth revenue will be, but I just think it's going to be really strong. It has to be strong given what we're seeing with other companies that I think have advertising businesses that are slightly inferior to what Amazon has. Now, we also have some other developments. Not only has Amazon pushed these online ads on the retail portion of the third-party sales, but they also push ads on Prime. Remember, Prime Video now has ads? They start off slow, so there's not many ads. You only watch like one per episode or something like that. So it's not going to be a huge difference. That's just another incremental thing to add into this budget. So I think advertising is going to be very strong this quarter. Then we move on to the subscriptions. Subscriptions are just steady, reliable growth. Nothing special here. You can basically just extrapolate it. I think it will be up around the same amount it is every single quarter. I don't think we're going to see anything really different. We move into AWS. This is another category that, based on all the comparables against the other public cloud companies, specifically Azure and Google Cloud Pro, I expect re-accelerated strong growth with AWS. If Azure is growing because they're getting all this AI demand and all these people are wanting to spend more on cloud, and Google's having the same thing happen, I believe that they have to have the same thing happen with Amazon. So AWS, I expect to see more strong growth ahead from this as well. And then the other category I add in here, but it's nothing. This is, $1.3 billion. It's basically a rounding error for Amazon's revenue. So overall, I'm very excited about the growth prospects of Amazon this quarter. I have to be honest here. I just think the company's going to do really well. You have the 4 different pillars of Amazon, the 4 most important segments of revenue, which is their third-party seller services, advertising, subscription services, and AWS. All of those are growing quite nicely. And based on every comparable I can find, I expect continued strong growth with each of them. Then the next challenge for Amazon is getting their expenses under control. Because if they grow all this revenue, all this high margin revenue, that's great. But if they grow expenses in line and margins don't expand, then that doesn't create any alpha. That doesn't create any opportunity. What we need to see is Amazon cutting down on expenses as they're growing this revenue. And I believe they will. And I believe we're going to see a continued trend of the CapEx remaining relatively flat to down while the revenue's growing. Now, the next question for Amazon is typically the valuation. We know that this stock has gone up a lot over the past year. It's been one of the best performing stocks. Year to date, it's up 20%. So it's really doing well this year. And even if we zoom out another year, it's up 76%. So we have huge gain and momentum in Amazon stock, which makes it a bit trickier going into earnings. Amazon, I believe, is undervalued, but it's not nearly as undervalued as it used to be. I think right now it's approaching closer and closer to its fair intrinsic value. I still believe it's around 15% below its intrinsic value. And I'll give you the math real quickly on that. If we look at Amazon right now, the stock is at a $1.87 trillion market cap. Okay, 1.87. When we look at that and we predict the stock is going to do $70 billion of free cash flow in 2024. If we do the math there and we divide 70 by 1,870, we get a yield of 3.7%. So that's what I believe Amazon's trading at right now. A free cash flow yield of 3.7%, 2024's free cash flow. And I believe the stock should trade around a 3% yield. With interest rates at 5%, I think Amazon deserves to be around a 3%. So if we look at Amazon being at a 3%, that means right now the stock is still around 20% undervalued. It could still go up another 20% before getting to this yield of where I think it's fair value. And then after it gets to this yield, I think that Amazon will grow its free cash flow per share somewhere above 10 to 15% per year from 2024. So I don't only believe the stock is undervalued today, but I think it has a nice growth path ahead of it. But either way, I go into this earnings report with high expectations, but we'll have to wait and see. If you want to see my reaction to Amazon's earnings report and review on it, just make sure you subscribe to the channel. Now let's go ahead and move on to Starbucks. And I want to pair my comments with Starbucks closely to McDonald's. I feel about the same way with Starbucks as I do as McDonald's. I think they're both in the same class of companies. They're both trading around the same valuation, and they both even have similar balance sheets. They're different in their models. One of them is franchise, one of them is wholly owned. So they're not identical companies, but I think the customer is going to be strong on both of them. My biggest issue with both of these companies, both McDonald's and Starbucks, is the balance sheet of the company. I don't like the amount of leverage they run. Starbucks has a lot of long-term debt, $12 billion in long-term debt, $3 billion in cash, and they have a lot of capital leases on top of that as well. So I'm not going to be buying this company just because I don't like that balance sheet aspect of it, but I think that Starbucks' earnings is going to be good, just like I do with McDonald's. Now, moving on from Tuesday, we get into Wednesday, halfway through the week. Before market open, we have Mastercard. Mastercard is one of my very large holdings in the passive income account. In fact, right now, I believe it's my largest position in this account. There we have it at the top of the financial category, an $87,000 position, currently around $15,000 in the green. And the reason that I own Mastercard is because I believe it's an exceptional company. It's trading at a relatively fair, reasonable price. And I believe in the long-term secular trends that will generate alpha with this position. Now, looking at Mastercard, it's not a company that I think is a nail biter going into earnings. This is not one that you need to get the popcorn out for. I believe Mastercard and Visa are companies that are just business as usual. You don't have to lose sleep over them. You don't have to be excited or concerned about them. It's companies that you could just own and forget about the earnings reports. There's usually nothing exciting happening. So going into Mastercards, I know it's fun to see an update on your largest company, but in terms of my expectations, I expect it to be mostly like Visa's, business as usual, maybe slight beat on earnings and revenue, and they'll have some commentary on the economy. If it's anywhere similar to Visa, which I believe it will be, I think the commentary is going to be that the consumer is resilient and strong and still spending money in every income demographic. That's the type of commentary we had from Visa. I think we're going to have the same thing from Mastercard. But as far as I'm concerned, this is not a nail biter. I think it's going to be a pretty routine earnings report. Next up, we have VICI that's reporting earnings Wednesday after market close. VICI is another one that I have in my passive income portfolio. Here it is as a $42,000 position, currently $6,400 in the green. Now, VICI has been a company that has underperformed the rest of my portfolio. So even though this one has positive returns, it has brought down the returns of my portfolio, especially this year. If we look at VICI, we can bring this one up here. This year has just been terrible for this stock. We look at it this year and it's down 11% year to date. Now it's paid a dividend, so it's not down quite as much if you factor in the dividend. But either way, going down 11% is not ideal. And it's the worst performing stock in my portfolio year to date. Going out a year, it's down 14%. And then 5 years, it's up 26%. Plus it's been paying big dividends the entire time. So that's the big part of their return, is the quarterly dividends they pay are anywhere from 5 to 7% yield, depending on when you buy the company. Jerome Powell has made it clear that interest rates are staying higher for at least longer, and now there's talk that maybe they stay higher forever. Maybe they never go down. With the dividend yield being 5.8%, you can find high yield savings accounts that pay you 5.5%. So VICI's competing directly with this, and I believe that's the biggest issue. The yield comparison between bank accounts and VICI. So investors are selling down this stock so that the yield gets higher and it gets more competitive with bank accounts. And that's something that VICI cannot fix. It's something out of their control. On top of interest rates going higher, it doesn't only affect the opportunity cost, but it makes it more difficult for VICI to do attractive acquisitions. Their cost of capital to borrow money has gone up. So VICI is also expecting to have slower growth. So you have a combination of a company that has a more opportunity cost with high yield savings accounts and a higher cost of capital slowing down their growth at the same time. For any REIT, the most important thing to look at over time is what's called the AFFO per share, the adjusted funds from operation per share. It's a fancy way of saying that this is basically like the free cash flow per share that a REIT is producing. For REITs, you don't use free cash flow, you use the AFFO per share. When we look at this KPI, we can see that it is going up steadily over time for VICI. But this is what is a concern for investors, that this growth they've had, where it's gone from 37 cents, 36 cents per quarter, up to 55 cents per quarter, is going to slow down. It's going to slow down and flatten out. That's a concern for investors. If VICI can continue to grow this at an attractive rate, that would be great. It's going to cause the stock to go up over time. But if it slows down like investors are expecting, then overall growth slows down. And it's like a company that's a bit more stagnant, just paying a dividend. So in terms of this quarter and execution, I think VICI is going to be fine. They're collecting all their rent. They're doing everything they can, deploying capital well. but they're in a tough situation where borrowing costs are up, interest rates are higher, and now there's a narrative that interest rates may even stay at their level or go even higher. So I'm not adding to this one right now. I am going to wait and see what interest rates do. Now, moving on from VICI, we move to Thursday after market close, where we get to the number 2 earnings report, one of the 2 biggest ones of the week, which is Apple, reporting earnings after market close on Thursday. Now, I own Apple. I've owned the company for years, and I've done well in the stock. Obviously, Apple's done well over the past 5 years. So this company, the stock price is up a lot. It's doubled a couple times. I have a current holding position of 41,000, 21,600 in the green, and I've recently trimmed my Apple position in both accounts. I took it out of the Story Fund, and I reduced my position size in the passive income portfolio. And I do that because I see more risks in the stock today than I have at any time period over the past 5 years. And it's hard for me to say this because I'm a huge fan of Apple. I love the products. I love the company. I have the AirPods. I have the iPhone. I have MacBooks, and I've used MacBooks all through work and college, and my wife used it when she was going into nursing school. She used the iPads. We love all their products. We love the iMessage. We love the FaceTime. We're in the ecosystem. So I'm a huge fan of Apple, and it's been a stock that's obviously done really well. So it's hard for me to say that it's now at a time period where I'm a little bit nervous. I'm just getting more nervous with the company. You know my feelings on European regulations. There's just so many regulatory changes they're making, and a lot of them seem like they're targeted at Apple. The massive EU legislation, the Digital Markets Act, seems like it was conceived just to regulate Apple and Amazon, big tech companies in the US. But in particular, it really focuses on Apple, tearing down their ecosystem bit by bit, making it so that they have to have different stores on, that people can bypass their payment system. So creators like Epic Games no longer have to pay Apple to launch their own store on their device. The EU has regulated what charging system they have to have, regulating it into a USB-C. Now that's convenient, but it shows the power of the EU to make changes to Apple devices. They've also regulated that Apple can't default certain apps, questioning whether they can even have photos as a default app, even though it's integrated into Apple's ecosystem, along with the camera. There's major changes the EU is doing, from onboarding of Apple devices, to what applications get on it, to how the economics work, to questioning whether or not they can even have the same wallet on the same system. And now the US legislation is doing the same thing. They're following in the EU's steps, doing the same type of regulations. Apple's being sued by US regulators as well. So whether or not you agree with this or disagree, that's a whole different subject. We're investors and we're looking at getting the best returns. Whether or not I personally agree or disagree with different aspects of the nuances of the regulation, I can set that aside and look at the best investments. Right now, Apple is being regulated harshly. They're having their ecosystem and their moat picked apart bit by regulators. And I see that as an overall degradation of their moat over time. So I view this as kind of red flag 1, the fact that Apple's being regulated harshly by the EU and the US at the same time, tearing down their moat or their ecosystem in the process. That's red flag number 1, and I've seen this happening over the past couple of years. But then we move on to red flag number 2. This is the recent TikTok ban that was passed. Now, a lot of people aren't familiar with the nuances of how this bill works, so let me quickly explain it. This is bipartisan agreement, meaning that both Republicans and Democrats came together and they realized that TikTok is a real risk to the US. That's the conclusion they formed. It shows that China has access to the location data of all the youth in the US. Not only do they have access to the location data, but from those apps, you can get other information off of phones. You know that you can do this because Meta has been in trouble for doing this. So you have China that has a direct access to hundreds of millions of youth phones with their location, with their interests, with their hobbies, with everything they're doing on their phones. Not only that, but they also have control over the algorithm, which heavily influences the beliefs and thoughts of the youth in the US. And China is considered an adversarial government to the US. We're not friends with them. It's not like Europe and the US or Japan, where we're kind of buddies. China is a foe in the US's mind. So US Congress is looking at this from the perspective of allowing an adversarial country, one that we're in direct competition with, one that we do not agree with, to have control over an algorithm that influences hundreds of millions of youth and gives them a host of data about information of different US citizens. And to only add to this concern, when they announced that TikTok was going to be banned, TikTok put a toast notification to every user saying, call Congress and tell them not to do this. So while they were discussing the likelihood of China to muddle in US affairs, suddenly they were called by tens of thousands of kids that had no clue what they were doing. They were just calling Congress, in many cases, some of them like 14 and 15 years old, saying, please don't ban my TikTok. Please don't ban my app that I use. They said some of them even sounded like they were in school, like they had a classroom in the background. And they're calling Congress saying, I was told by TikTok to call you and tell you not to ban my app. So in a sense, their toast notification that they pushed out to tell all the members of TikTok to call Congress, it backfired spectacularly on TikTok. It really influenced Congress that TikTok has huge control over people's opinions and can definitely be used to influence elections. With these concerns of the Chinese government having this much direct access to the youth in the US and being able to muddle in US affairs, this bill that is used to ban TikTok was passed quickly through the House and Senate, and it was just recently signed by the president, meaning that it is in effect right now. Now, there's a lot of misinformation that's been passed around saying that this bill gives you 90 days to sell TikTok. That's not correct. It gives you 270 days to sell TikTok. There's also some misinformation that TikTok has to be sold to a US company. TikTok does not have to be sold to a US company. The bill states that it can be sold to any company from any country that's not considered a US adversary. There's only 6 countries that are US adversaries, like Russia, North Korea, China, Iran, so on. Those type of countries are considered adversaries to the US. Any other country, it's fair game. So a European company could buy TikTok. Japanese company could buy TikTok. A Canadian or Mexican company could buy TikTok. And over the next 200 days, they could have a worldwide bidding war over this asset. So this is very big news, and it's a very big development that directly impacts Apple. Because as this is passed, if it's true, and if the courts don't strike this down in a lawsuit, that means that China is going to be very upset. They're not happy about one of their prized assets being forced to sell or banned in the US. And as a result, they said that they are going to retaliate. They will be hitting back prized assets in the US. What is one of the most prized assets in the US that also has a huge market in China? Well, of course, target number 1 is Apple. China is a huge market for Apple, and if TikTok does end up getting a forced sale or a ban, China is most certainly going to respond by retaliating against Apple. Now, we don't know the magnitude or extent they will retaliate, but they are going to retaliate. Target number 2 is probably Tesla. China is also a huge market for Tesla, so that's one that could be in the crosshairs as well. But Tesla, I believe, is even more optional than Apple. I believe Apple is target number 1. So this is just an unfortunate situation for Apple. They're in the midst of this tit for tat of China and the US regulating and banning different companies. And Apple seems to be one of the ones that's going to be used to send a message to the US if they pass this bill, or at least if they act on this bill. Now, again, we just visit some of the concerns here. I have concerns already between EU and US regulations, picking apart Apple's moat. But then I also have the concern of the retaliation from China. That could affect the business in a dramatic way. And then there's also just not great news with product development. For example, I look at this article. Almost nobody is buying Apple's super expensive Vision Pro VR headset. And they say that we're shocked. I think they're saying that sarcastically. But it is true. When I look at it, I don't know anyone that has this headset. I know a lot of wealthy people. I know people that can afford it. I just don't know anyone that has it. Nobody talks about it. I know everyone has AirPods. Like everyone around me has AirPods. Everyone has an iPhone. Do you know that many people that have the Vision Pro? I just know nobody willing to spend $3,000 or $4,000 on it. And I'm not either. I'm a huge Apple fan and I didn't buy them because I think I'll get bored of them. That's the problem with VR headsets. And that's why I'm not that bullish on the metaverse with Meta. And I'm also not super bullish on Apple's Vision Pro headset. It's not a product that I think will ever be a massive category. So overall with Apple, I just have a list of concerns that I haven't had over prior years. And that has made me reduce my position a little bit to reflect my increasing concerns for the company. Now that doesn't mean they can't do good. Maybe the company will outperform and services will grow faster. They'll sell more iPhones and things will go really well. but I just think there's more risk in the stock. So as of right now, with all of this stuff going on with it, I am bullish on this quarter. I think this quarter will be fine, but over the next 6 months, the next year, call me cautiously optimistic. I'm very cautious about Apple right now. It's not one that I'll be buying hand over fist any dip in the company. There's ones that I think are far more predictable right now that I'm putting a bit more emphasis on. Now, finally, we move on from Apple and we get to one of my favorite companies here. It's reporting its earnings at the same time, Thursday after market close, which is Texas Roadhouse, the US-based restaurant company. I invested in Texas Roadhouse because I have a personal experience with the company. I've gone to different Texas Roadhouse locations for the past 15 years, and I've noticed that they're exceptionally well ran, well executed. The manager of the location always checks on you. They always come and say, how was your meal? Was your meal good? Was everything cooked right? Can we redo any of the steaks if they're cooked wrong? Right? They're there to make sure you have a good experience, and that keeps customer loyalty. So I've noticed the good experiences from Texas Roadhouse, the exceptional execution and operations of the company, and I noticed how it was routinely busy every single weeknight and especially on weekends. Super packed on weekends to the point where they developed a waiting list app to just help with the amount of traffic they get every weekend. It became a company that was on my radar when I paired all of that type of qualitative stuff with the fundamentals of the company. I thought, okay, it seems like a good company on the surface, all of my experiences, but I need to see if the numbers are good. When I look at the numbers, they're amazing. They're not good, they're just amazing. So I invested in the company. I tried to buy it with a margin of safety when it was around $70 per share. And it's recently, or at least ever since I purchased it, it's just gone up and up and up as they've grown their earnings at rates of 16 to 20%. So the company's growing its earnings per share as fast as big tech, and they have been for the past couple of years. Right now, the company is a $70,000 position, one of the largest positions in my portfolio because it's nearly doubled, or in fact, it has doubled since I purchased it, up to $34,000 in gains. So this has been a huge winner. On top of doubling in market cap, the company has also paid big dividends. So I look at Texas Roadhouse going into this earnings, and what do I expect? I think the earnings are going to be really good, but I am concerned for an aftermarket sell-off. The reason that it concerns me is because Texas Roadhouse has gone up so much so fast. It seems like it's going up every single day with a ton of momentum. Right now it's trading at 160, another all-time high today. To give you an idea of how good Texas Roadhouse has performed, so far this year, Texas Roadhouse has outperformed all of the Mag 7 except for NVIDIA. NVIDIA is the only one that's outperformed Texas Roadhouse. So this company is crushing it year to date. And the company's not in the S&P 500. So this is one that's excelled above the S&P 500. It's giving me a lot of alpha in my portfolio because it's a non-SPY company that's one of my largest holdings. With any stock that races up this fast, there's always concerns going into earnings reports. They'll have something that disappoints. But even if they do, I am not concerned with Texas Roadhouse. I still believe the secular trends of restaurants are going to do really well. This is one of the best executed restaurants. I think it will continue to execute like they are. And I think it's very difficult for other ones to follow their formula. So I go into this earnings with a lot of confidence. I don't have any concerns about it. If they do sell off, it's an opportunity for buybacks. It's an opportunity to add more. Now moving on, we get to Hershey's, which is reporting earnings before market open on Friday. Hershey's is not a stock that I own in either of my portfolios, but I think it's a great quality compounder. It's faced some concerns from investors around different brands that are entering the market created by content creators like Mr. Beast. He has a lot of viewership, a lot of influence, and his Feastable bars are making their ways on different shelves throughout the US. So that's always a concern when you have a new entrance to the market. How much market share can Feastables take from the Hershey's company? So with Hershey's, the primary thing I'm going to be looking for is evidence of market share being taken. And you can see that typically by the volume and pricing of the company. If they have volume declines while other companies are gaining in volume of sales, you know that they're having market share taken. So that's the primary thing I'll be looking at. So that's a look at the full week ahead. If you want to see follow-up analysis where I go over the earnings reports of Amazon and VICI and Mastercard and Texas Roadhouse and Apple, just make sure you're subscribed to the channel with the bell notification on. That's all for this time. See you in the next one.